Welcome to Retire Well TV. My name is Cynthia DeFazio, joined today by Sean Odrabanak of Citizen Advisory Group. And to our viewers at home, we have a very special episode for you today, something called the Great Wealth Transfer. Well, if you were born between the ages of 1946 and 1980, those years in there's something that's going to be happening called the Great Wealth Transfer. Sean's going to shed some light on exactly what that is today, and most importantly, how you can protect yourself and your loved ones for years to come. So again, 1946 to 1980 are the years to be watching out for if you were born during that period of time. Well, I have to ask you, Sean, how are you today?
Oh, I'm doing fantastic. I'm glad it's just you and I. We got rid of Pete, we got rid of Kevin, so we get to spend some quality time together.
We do.
So I'm looking forward to today's show.
I am too. So where are they in the Bahamas? Are they soaking up sun? What's going on?
Well, Pete kind of burns easily, so I don't think he's going to be around the sun anywhere,
Okay.
But Kevin might be on a cruise ship. Who knows?
All right. Excellent. Well, I am so honored to be with you today. So thank you for having me as your host. And we're going to talk about something that's so important that a lot of people are unaware of, called the Great Wealth Transfer. So Sean, first of all, what exactly is the Great Wealth Transfer? Can you shed some light on this?
Yeah, so the Great Wealth Transfer, this is going to be the largest wealth transfer in the history, right? So there's expected to be around an $84 trillion that are going to be passed from the baby boomers onto the millennials and the Gen Xers. And, you know, we know this,
Wow.
We see this, and there's actually been some legislative changes around some of these assets that we're going to talk about. But, you know, we start to look at this transfer of wealth that you've worked your entire life to have your nest egg at whatever dollar amount it is, and it's your hard-earned money. And we're going to talk about this today because we feel that your hard-earned money should go to you, your spouse, your beneficiaries. They should get the lion's share. And what we're going to discover here is that, you know, some of this money that you have, it's not all yours.
Uh-oh. So that number is sticking in my head. You said 84 trillion, not billion, but 84 trillion. So with that being said, that amount of money that's being transferred, who does this great wealth transfer impact the most? Who is it going to affect the most?
Yeah, I would say that those that are going to be most affected by this, obviously the first is going to be the account holder, right? So there's certain things that we can do with your wealth while still living, and we should probably take some proactive management. But then the secondary is the beneficiary, right? So who's going to get these assets? Is it going to be your kids? Is it going to be your grandkids? Where is this money going? Because on paper, on your sheet, you might have one or two primary beneficiaries, so 50-50 split. But if you're in a specific account, you got a third beneficiary on that account, and that's the IRS. Right?
Uncle Sam.
So we gotta figure out how do we get Uncle Sam out of your business so that your hard-earned assets go and they avoid those things and they go to where they want them to go.
Sure, because we should also talk about what could be some tax implications that come along, Sean. That is probably something big that we're going to touch on today.
That is 100% true. So at our firm, we do comprehensive financial planning, and that entails retirement income planning, investment management, tax planning, risk mitigation, and then legacy and estate. And I think today we're going to be bouncing in between the tax planning as well as the legacy and estate planning. And why I make a point to that is because we're financial planners, we're financial advisors, and it's really hard for the consumer to delineate between what kind of financial advisor do I have, right? Because some financial advisors, they just sit in that one space of the investment management world. And if you have that, I want to encourage you to pay attention to today's show. Listen to what I'm saying, because if you learn something today from this show, you know that your advisor doesn't do this. And if your advisor doesn't do it now, you got to take action, because this is your money. And there's things that we can control, and there's things that we can do to get Uncle Sam out of our paycheck.
From your perspective, Sean, we're talking about the great wealth transfer. Why does this matter so much?
You know, I think I teased on it a little bit, where this is your money, right? This is your life savings. You put some money away, you know, whether that was 25, 30, 35 years ago, right? Maybe you had a defined benefit plan maybe that pension froze and we don't have that plan, then you got a 401k or a 403b or some type of tax advantage, tax qualified plan. And so we started putting our hard-earned dollars into this account. And during those years, you're raising a family, you're going to work, you're going without. But you are earmarked this, and I'm going to put X amount of dollars away, and that's going to be mine in retirement. And what I find so often is that you've worked so hard for this money, and now you're afraid to touch it. You just want it to sit there, and you want it to grow, and it grows, and it feels good. And we're going to talk a little bit about the legislative changes that have happened, specifically around these particular accounts. It's important because this is your money.
It is.
And we need to accomplish a couple goals with your money. Well, and I think what was really going to align with most of our viewers today is that we got to get Uncle Sam out of our assets, our money.
Yes.
And there's ways that we can do that.
I have to ask you, are most families actually prepared for this, or are you finding that most people are doing little planning for the great wealth transfer?
I would say that's about half. Right? It's hard to put an actual number on it, and I think some people just aren't educated enough on transferring wealth. And what I mean by that is, you can transfer your wealth because your primary beneficiary is your spouse, right? So hey, I've made sure that I have the proper beneficiary, and then I've made sure and I have my contingent beneficiaries on my account. So I don't want to diminish that. That's important, right? We got to do that first and foremost. But we also got to say, well, what are the other assets, right? What are your capital assets? Do I need a trust? What's a legacy look like? What is your legacy plan? Do you want to leave a legacy, or do you want to live a legacy? And what I find at our firm, and one thing that I empower most of my clients is, you want to spend your money with those who matter most to you, whether that's your spouse, your kids, your grandkids. It is far more important to live a legacy from my perspective, because I've seen transferring of wealth. I've seen just leaving money behind. And it's nice if they get it, but I can almost say that they would much rather have spent that time with you doing the things that were important to you guys, because the memory, you're never going to miss the memory.
It's very, very true. And Sean, we're going to take a very short commercial break, but let's talk a little bit about, there's an offer that you have today to the viewers at home. Spend some time sharing with the viewers what that is exactly.
Yeah, so at our firm, I teased it and I said, we do a comprehensive financial plan. And today is going to be specifically around the tax planning and the legacy planning. But what I would encourage you is that come in, right? This is the feature of our firm. We look at these 5 areas of financial planning. And what you're going to find in that introductory complimentary consultation is that this is what we do. This is our process. And then you're going to see the next layer down, that the process is going to provide you some value, right? And that's really where that's the benefit to you, is because you might not have this plan already. You might just have some investment management, and to a degree, we really can't control what the investment world's going to do, right?
It's true.
But there are other areas that we do have control, right? We know what the tax code is. We know the recent changes of the tax code. We know what happened with Secure 1.0 and 2.0, which I think we're going to talk about in the next segment.
Yes.
But I would urge you, pick the phone up, call 866-630-1675, scan that QR code, and come in for a no obligation complimentary consultation, where we're basically just going to learn a little bit about you, how we can provide a little bit of value to you, and then we'll see how it goes from there.
Sean, thank you so much. To our viewers at home, please click that QR code at the bottom corner of your screen. That takes you right to the landing page of Citizen Advisory Group, and you can schedule your consultation just from visiting that website. That QR code is the fast track to get you on the schedule at Citizen Advisory Group. When we come back, we're going to talk about how you can avoid falling into some tax traps that can happen if you're not expecting the great wealth transfer. Avoid those tax traps. Stay tuned. We'll be right back on Retire Well TV with Sean O'Drabenak.
My name is Sean O'Drabenak, and I'm one of the financial advisors at Citizen Advisory Group. I became a financial advisor after I met Jeff almost 5 years ago now. It was something that I've kind of been passionate about. I've always been really good with numbers. I didn't really know how to make a career out of being really good at numbers, right? So when Jeff and I met, we started talking just about what Citizen Advisory Group offers to the clients and how he saw that I could actually provide some value to his firm. And from there, here we are. I think the first thing is that you got to wake up and you got to love what you do. Where I find my joy and my happiness is with the people that I love, right? Obviously, my wife, my kids, but it extends beyond that. And that's my home family. That's the home team. But we got a pretty good family atmosphere at the office as well. So, getting around the people that care about the things that I care about really is what makes, our firm unique. So I would say people that I love, things that I love to do, and serving just kind of inspire me each and every day.
Welcome back to Retire Well TV. My name is Cynthia DeFazio, joined today by Sean O'Drabanak of Citizen Advisory Group, and we're talking all about the great wealth transfer. How does that affect you? How does that affect your loved ones? Today's show is how you can be proactive and plan properly for the great wealth transfer. So Sean, this is so amazing to me. I'm listening to you share insights to the viewers at home, things that they probably aren't thinking of currently. One of the things that you alluded to gently in the prior episode, or segment I should say, was the importance of tax planning. So without that, talk a little bit about some tax traps people can fall into when we're talking about the great wealth transfer.
Yeah, and let's make a clear distinction between tax planning and tax preparation, right? So tax preparation is reactive, right? It's already been played. You have an EA, you have a CPA, you have, maybe your dad did your taxes, so you just go to that person because they've done a great job, right? But that's the difference, is that, you've played the game, you've taken whatever from whatever accounts, and you give them these scorecards, they tally it up and they say, this is what you owe, or you withheld, or whatever, right? So that's tax preparation. Okay. Everybody does tax preparation. But I want to shift because I want to talk about tax planning.
Okay.
Tax planning is more forward thinking. It's looking ahead. It's saying, all right, through that written income plan that we create from you, when we determine where your sources of income are coming from, we got a pretty good understanding of what your actual annual tax implication is going to be. So once we have that and we've covered your need, well, now we can go and look at your investments, because maybe we have some of these qualified plans, or a tax advantage plan, or a pre-tax plan. There's a lot of different names for the same accounts, right? So let's break that part down real fast. So a 401k, a 403b, a 457, a 401a, right? All of these are tax advantaged or pre-tax positions. An IRA, an individual retirement account.
Okay.
Tax advantage. Now, what I love about this word is that the tax advantage is you got a deduction in that year. So when you put money into one of these accounts, the advantage was in that year.
Okay.
But when I look at retirement, right, is it an advantage to get a deduction in that year, let it grow, all tax-free, and now in the future at unknown tax rates, you're going to have to take that money out? Yikes. I mean, I look at this and it's almost by design.
Yeah.
Why? Because there's $84 trillion of assets that are going to be passed down from the boomers to the next generation.
Wow.
At the same time, we got $38 trillion of debt.
Yeah.
I love asking this question, and you're sitting at home right now. Who thinks taxes are going down in the future? Anybody?
No one that I know would say yes.
No, right? I had one person, I've asked this question for years, and I've had one person say, I think they're actually going to go down. I was like, okay, we'll just let you, there's got to be an anomaly, right? But we got $38 trillion of debt.
Yes.
Right? And in the first segment, I talked about the Secure 1.0 and the Secure 2.0 Act, right? So the legislation that was passed around these particular accounts, the IRAs, the 401k, specifically the IRA, Secure 2.0 actually eliminated what they call the stretch IRA.
Okay.
So in 2019, Secure 1.0 came out. Okay. Like most of our tax legislation, it wasn't that clear, so we had to make a Secure 2.0.
Okay.
Right? So Secure 2.0 came out in 2022. All right. And This is where the big change happened, and this is where we have to have tax planning.
Okay.
Because prior to 2020, if you inherited some money in one of these IRAs, 401k, whatever that, you could stretch that balance out for the beneficiary's lifetime.
Wow.
Right? So maybe that generation is 20 years younger, and now I got to take a distribution, but I can stretch it over my lifetime. Well, Secure 2.0 eliminated the stretch. They reduced that and they said, hey, if you get some money in my qualified account, that account has to be done in 10 years. So let's just hypothetically throw an example out there. I have a client who's got approximately 2.2 million of investable assets in IRAs. He's got 2 beneficiaries. They do extremely well.
Okay.
So now, in the event that they pass, the 2 children are going to inherit $1 million each in an inherited account.
Yikes. Okay.
Now, if we think about the demographic that you were talking about, right?
Yeah.
So now we're in the millennials and the Gen Zs. Well, they're in the prime working years of their life.
100%.
They are making a pretty high wage. They're probably in one of the 22%.
Absolutely.
I'm generalizing.
No,
right?
I understand.
But now you have this wage,
Yeah.
and now you're forced to take this distribution out of this account in 10 years. So you're going to be
Holy moly.
above the 22. Potentially, we don't know. But you know how we know? You go to mytaxbilltest.com, scan the QR code.
Yeah.
If you have qualified assets, put it in there and run a tax scenario, right? What it's going to show you is it's going to show you your lifetime tax obligation to the government. And that number, in my experience, is pretty alarming to folks.
I'm sure.
Right? And so when you actually see, hey, this is what I got,
Yeah.
and then you look at the tax implication of what my life savings and my hard work actually means, you're giving a lot of money back to the government.
It's staggering.
It's very staggering. And
Yes.
the other component to the Secure 2.0 was they actually they increased the RMD age. So it was 70 and a half.
Okay.
And then it was 72. It's currently 73, projected to be 75.
Okay.
And people think that this is good for them. Hey, I don't got to take money out of my account. But all the while, you're letting it grow. You're letting it grow in the IRA, the 401k, the tax advantaged plan. All you're doing is you're increasing your tax bill to the government. So please pick your smartphone up. If you don't got a smartphone, go to your computer, type in, go to our website,
Yeah.
right? mytaxbilltest.com. Go and learn for yourself about what your situation is and what your future liability is going to be.
Sean, thank you so much. To our viewers at home, do not miss the opportunity to take this short test today. All you have to do is pick up your smartphone, click on that QR code that'll take you right to the landing page of mytaxbilltest.com. You'll put a little information in about yourself. You can play around with different scenarios, if you will, pick different incomes, different tax brackets. You'll receive an email with your current tax burden. It's staggering. I did this myself. It takes maybe 5 to 7 minutes of your time. Once again, mytaxbilltest.com. We're going to take a very short commercial break here. Don't go anywhere. I have so much more with Sean about how we can prepare for this great wealth transfer, and most specifically, how to avoid passing a tax time bomb on to your loved ones, to your heirs. Stay tuned. We'll be right back momentarily.
Citizen Advisory Group's located in Perrysburg, Ohio. We serve Northwest Ohio and Southeast Michigan primarily, although we do have clients around the country.
We have a culture of people that enjoy working with and helping others. That extends to our clients, but it also extends across the teams.
For a firm to thrive, you have to protect the culture of the company. And what that culture really resonates with is people first, is serving first. If you don't have a servant mindset or a heart to help other people, you're not going to fit.
I think it's very evident from the people that answer the phone, to the financial advisors, to everywhere in between, all the work that's required to handle a financial plan and a retirement plan for someone. You can feel the care and the love.
Imagine not having to face your retirement with the same old corporate solutions as everyone else. In these economic times, you deserve a fresh perspective that includes a personalized retirement income plan, investment portfolio analysis, and tax map from an independent fiduciary advisor whose focus is on you. Call the number you see here to schedule your complimentary review right now.
Welcome back to Retire Well TV. My name is Cynthia DeFazio, joined today by Sean O'Drabanak of Citizen Advisory Group, and we're talking all about the great wealth transfer. How can you be prepared? How can you avoid these tax time bombs? And most specifically, what about your loved ones? So Sean, I know people are waiting with bated breath right now. What can they do? What are some solutions? And you're so passionate about talking about something so amazing called the Roth conversion. How do they work and why is it a powerful tool?
Yeah, Roth conversion is a tool that we can use for the tax planning segment, right? And you know, we've primarily talked about the wealth transfer from generation to generation, but there's a first transfer that I want to make very clear because it coincides with the Roth conversion, right? So on average, husband and wife, the wife typically survives about 5 more years than the husband. Females typically live longer. So the first transfer of wealth is going to be from married couple to a single filer,
Wow.
right?
Okay.
So I know most of this has been around, you know, for passing on to my next generation. But there's 5 years here that the government's going to potentially get into your retirement plan, your nest egg, if you don't take action.
Wow.
Right?
Okay.
So let me paint a picture for you. Husband and wife, a $2 million account. The moment that one of them pass, we are going to lose a source of income. If we have 2
Yes.
Social Securities and we're taking some money off the portfolio, if we got a pension, one of those Social Securities is going to go away, right? So you're going to lose the lower Social Security. So immediately the surviving spouse has less. But now, if you're the primary if you're the primary beneficiary on this IRA,
Okay.
well, now the wife assumes those rules as her own.
Okay.
So she has less income. She's now also a widow. She's a surviving spouse. She has less income and she's a single filer.
Yikes.
And single filer tax rates are not nearly as advantageous as married filing jointly. So
Yeah, it's true.
from preparation to planning, we're going to have a tax plan on the sole survivor through Roth conversions. Because it's likely that the moment that one of you pass and now you have these RMDs that you have to take off of your IRA, well, you're probably, the surviving spouse is likely going to be in the 22% tax bracket and potentially paying more for their Medicare insurance.
Wow. Yes.
So we got to have a tax plan for in the event that one of us pass, but then we also have to have a tax plan for passing that generational wealth.
Sean, I should ask you a very important question. How many people coming into the office for the very first time, if you will, have an actual tax plan?
Oh, you know, I think that's a very low number,
Yeah,
right?
I would think so.
People are smart, and we're in the generation where we can go and search up any, you know, what is a Roth conversion, right? And, you know, if you go and you look at mytaxbilltest.com, you can actually start to say, hey, here's my future obligation, and it'll show you that if you move this money, you're not going to pay tax again, right? But most people don't have an actual tax map or understand what does the tax look like next year, the year after that, the year after that. Because Roth conversions are great. Roth IRAs are great, but you got to start with the end in mind.
Absolutely.
We have to understand, what are we trying to avoid? Because if you do nothing, you're going to be in this account. It's going to be kicking off some RMDs that you have to take no matter what to satisfy the obligation of the IRS. But you can actually move some of those accounts from your traditional IRA to your Roth. You pay tax on that one time, and then you never pay tax on that again. There are no RMDs in those accounts.
Wow.
They grow tax-free. And where is the advantage? It's that first transfer of wealth. Now you've created a bucket of tax-free money for the surviving spouse. And it's critical.
Absolutely.
So we got to have a Roth conversion strategy around surviving spouse, but then also around generational wealth transfer. And if we go down the generational wealth transfer, you know, that opens up other possibilities as well. As you know what, maybe maybe we don't have to reduce all of our IRA. Maybe we take some of those IRA dollars and we fund a life insurance policy.
Absolutely.
Because now we're going to leave tax-free wealth to our beneficiaries, right? So there's different strategies that we can have around getting the government. You can pay the tax now. You can put it into a life insurance policy. We can put it to a Roth. But your portfolio is really going to be the one that kind of figures out what feels best and how do we do it.
Absolutely. So it's so important to be proactive when you're helping someone navigate these years. I should ask you, legacy planning is a huge piece that you focus on as well.
Yeah. And I said earlier in the show, I am a big proponent of living a legacy, right? This month, you're going to do three things with money. I've said it in the past. I'll say it again. You're going to save it. You're going to spend it. You're going to give it away. I can't stress this enough. I want you to spend your money. I want you to go and do all of the things that you dreamt of, desired, hoped for, wished for, that you pictured retirement was. I know the advisors at our firm want that. We want to see you thrive in that. It's far more impactful than just leaving money to your children.
Most definitely.
So we have to have a legacy plan. That might mean we're going to get busy living. That might mean we're going to go down and we're going to open a trust. Or maybe we just TOD the home and we don't need a trust. I don't know. Your situation is really going to determine whether we need a trust or not. You know, there's ways that we can get around probate because ultimately we got to get probate out of our business.
Okay.
We got to get the IRS out of our business. We got to have a proactive legacy plan. And there's no one size fits all, right? We got to learn about each other and figure out how do we best do this. And sometimes we use a trust, sometimes we don't, right?
Yes.
But I can't stress enough. I can't help, we can't help until you pick up the phone. The number's right on the bottom of the page. I would read it, but most of you can read, right? Pick the phone up, make that call, come see me, come see Pete, come see Kevin when they get back from the
Bahamas,
cruise or wherever they are, right? Come see one of our advisors at our firm because one of the things that we are passionate about is serving others. And we really would love to serve you and your family.
Sean, thank you so much. To our viewers at home, thank you for spending time with us today on Retire Well TV. Once again, that QR code is at the bottom corner. Go ahead and click on that and schedule your complimentary consultation today with the team of Citizen Advisory Group. They are here to serve you. Be safe, be happy, and be blessed. We'll see you next week. Take care now.